From R.D. Smothers Wealth Management, this is The Retirement.
When you retire, if you want an exciting life, you need a boring investment strategy.
Matters.
If you enter into retirement without a plan for income, you're not retired, you're simply unemployed.
Podcast.
Hey, this is your host, Dale Smothers, and you're listening to the Retirement Matters Podcast. My hope is that you will find the information you need in every single show on how to do one of the three things: either saving more money more efficiently, planning better for your future where you can live in retirement worry-free, or my favorite, how you can live a happy and fulfilled life in this life you have been given. We know that your time is valuable, and we appreciate you spending it listening to this episode of the Retirement Matters Podcast. On this episode of the Retirement Matters Podcast, we go into what you would want to be doing now, depending on your time horizon in your investment philosophy. And I want to make an editor note here and let you know that you're listening to a show that aired live on the radio on the 23rd of August, 2025. And you will hear us reference Friday, what happened on Friday. And that Friday was the 22nd of August, 2025. For many of you, that may be a week ago. For some of you, it may have maybe many months ago, depending on when you're listening to the show. But what took place was the Federal Reserve met in Jackson Hole at their symposium, and the Federal Reserve comes out and all but announces a rate cut coming in September of 2025. And what took place from there was the market went higher, significantly higher. And what you saw is probably something that sparked a little bit of an emotion in you if you were paying attention. For those who aren't paying attention, they're opening their 401ks right now. They're seeing higher than ever valuations inside of those 401ks. If you're not seeing that, you need to be talking to an advisor. We'd love to be that person for you. 270-600-PLAN. But one thing that you will find is that even in the height of the market, there is still uncertainty about what is to come. And with that, the uncertainty of what you should be doing in your own situation. That is one thing I know that our team can help you with. If that is you, you need to be talking to us soon. 270-600-PLAN or rdswealth.com. Navigate over to our website and set up a time to talk to somebody. We'd love an opportunity to chat with you. Now, our heart for this show was to give advice to those who are younger as well as those who are closer to retirement. So if you're 20, 30, 40, 50, 60, or even 70 years old, you are going to get some really good ideas from this show. And if they're right for you, deploying these into your portfolio may help you achieve the objectives you're after. And again, for compliance sake, I've got to tell you, everyone's different. So don't do this just because Dale said it on his podcast. Get in front of somebody and make sure that it works for you. One other piece of advice I'll give you is that we benefit greatly from getting our message out to other people just like you. And one way you can help us do that is by liking and subscribing and giving an honest review to our podcast. If you've heard enough of these to give us a review, we would greatly appreciate you going to the little section where you can give us the star rating and an honest review, a feedback, if you will, of what you like about the show. We look forward to talking to you in person at some point, or if you're just an avid listener of the show, we appreciate you tuning in each and every week. So without further ado, let's get to this week's episode of the Retirement Matters Podcast. Good morning to you. I hope you're doing well and you are ready to start discussing all things retirement matters. We're going to jump into a show that's going to be jam-packed with good information. If you are close to retirement or you are very far away from retirement, we're going to discuss with you what you should be doing in the current market environment you find yourself in right now and how you should be approaching your own retirement investment goals. Now, if you've heard the Retirement Matters show before, you are familiar with the fact that we give a lot of advice for those who are approaching retirement income phase because it is the most complicated series of decisions you must make in this two-phased retirement that we live. We talk about the growth phase, and then we talk about the income phase, and the difference between those two are so vast. It's almost like night and day. So many people are served fairly well in the growth phase, but the income phase is significantly underserved. We have people who are equipped to help in the growth phase and ill-equipped to help in the income phase, yet they still give income phase advice. If you are a person who is navigating through income phase and your advisor can't give you the definitive answer as to whether or not you can retire, or maybe your advisor can't help you understand when you should be taking Social Security and why. Maybe your advisor's not helping you navigate Medicare and all the complexities. That same advisor should be able to help you do this. Maybe your advisor's not building a true tax plan for you. I'm not talking about doing your taxes. You don't need a financial advisor to do your taxes. You need a financial advisor to build the plan. The tax preparer can report to the IRS what the taxes were, and we definitely need CPAs involved in the plan. I'm not devaluing CPAs. We work with CPAs all the time because CPAs give us the precision for this year's taxes, assuming everything that happened last year will take place this year. But it's very difficult for a CPA to give that type of planning advice necessary for 5, 6, maybe even 10 years down the road. That's where your financial planner comes in, and that is exactly where we specialize in at RDS Wealth. But today's show is going to be rather unique because we are going to be discussing things that you need to be doing in your investment plan, whether you are 5 years from retirement or 25 years from retirement. This type of investment philosophy is what we would call long-term growth focused or short-term / income focused. Those two philosophies require different things, and we're going to cover both of them today based off of what has taken place in the last week in the market. So you're going to have a lot of good information no matter where you are in your journey on today's show. Remember, it's all about the advice. It's not saying you need to do this, but we are going to give some philosophy. We're going to give some things that you can deploy, you and your advisor. If you don't have one, give us a call, 270-600-PLAN, or navigate to our website, rdswealth.com. Schedule a time to chat with us, and you and your advisor can sit down and start to craft your own plan for retirement. Let's jump into today's positive focus. Today's pause for positivity is going to be very short. As you can tell, I've already wasted I don't guess it's wasted. That's the wrong word. That's not a good word at all. I guess I've taken 4.5 of our minutes together, and I've only got a little bit of time with you every week, so I'm going to take my time on areas that need to be taken, but I better hurry up through some of them. And this is one that won't take a lot of time. This pause for positivity this week is very simple. I want you to do something with me. I want you to fold your arms. Just where you sit, I want you to fold your arms. If you're driving, maybe you do this one later. Fold your arms. And I want you to look down and see which arm is on top. Which arm is on top? Now I want you to consciously do it the opposite way and see how that feels. Does that feel different? Does that feel odd or strange? Chances are good that feels a little bit different than you're used to. It may not even be comfortable. Let's go back to the other way. The other way feels more natural to you. And if you look over to your partner beside of you, maybe, or around you, they likely have theirs done a different way. How are their hands? Are they in fist, or are they wrapped around their bicep? Are they up underneath of their arms? What does that feel like to you? And can you mirror theirs? Chances are good you can't, because your habits are unique. This is the same thing when we are trying to form better habits for our person, who we are. If we're trying to become better people and we are consciously trying to grow inwardly, there are going to be times where we're a little bit uncomfortable. There are going to be times where we make mistakes. There are going to be times where we have to slow down and consciously make that change because we just don't know how to do it yet. It's not quite yet muscle memory. But change is something that can happen. And the more you do it, the easier it becomes. The more you do it, the easier it becomes. If you've still got your arms folded, do it the opposite direction now. And that may be the second time or the third time you've ever folded your arms like that in your life, yet it was easier than the first. And if you did that every single day consciously, eventually it could very easily become muscle memory. Dale, why are you telling us this? Well, not because I want you to know how to cross your arms the other way, but I want you to realize that something as simple as crossing your arms, in order to do it differently, it takes a lot of time and effort. It takes more time than you would imagine. And sometimes to become a better you, it just takes some time. Don't be hard on yourself, and don't be hard on others. Give them the grace they need, because the grace that you have been given was given freely. And if we're talking about a spiritual grace, that heavenly grace, it was a free pardon from sin. We know who gave it to us. And we want to extend that grace to others in all areas of life. If we do that, it's going to be a beautiful, beautiful place to live here on this earth. All right, we're going to take a quick break, and we are coming back with a little bit of an understanding, a very quick understanding of what's going on right now, why the market moved so positively on Friday, if you paid attention, and what it means for you. Don't go anywhere. We're coming right back with more Retirement Matters after this.
It's 4th and 1 with 2 seconds left in the game. Less than 1 yard separates you from victory. You have the best running back in the league, but your coach calls a Hail Mary.
As silly as that sounds, we see a lot of retirement managers being far too aggressive with your investments when a more conservative play would be a better fit. You have questions, we have answers.
Contact R.D. Smothers Wealth Management, 270-600-PLAN. That's 270-600-7526.
All right, welcome back. Now let's shift gears for just a minute, and let's talk about what's going on to the market right now. On Friday, you saw the market go up pretty quickly. Around 10 o'clock, it went up and stayed up for the rest of the day, and it closed at a near all-time high, depending on what index you track. The S&P 500 is the predominant index that we track for the overall stock market, rather. The S&P 500. And the S&P 500, for the sake of argument, we'll just say has been led up by the top 10 stocks. We've talked about that in the past. The S&P 490 bottom stocks hasn't done a lot this year, but the S&P 10 has done really well. It's done so well that it's pulled the entire S&P 500 up to all-time highs, as we mentioned. These record highs continue to be hit. But about 2 weeks ago, the market started a sell-off. Now, we could have attributed that, and many of us did attribute that to the financial winter, which tends to come around August, September, and October. This financial winter is normal, and it's not something we ever panic about. We could see as much as a 10 or even 15% sell-off in the S&P 500 and not be concerned, because it happens almost every year, and almost every year something around this time of year happens like that. Most of the time, September is lower. It's a negative month in the market. Historically speaking, over 56% of the time, since we've been tracking the S&P 500, over 56% of the time, September is a negative month. And we just come to expect it. There are many reasons, and we won't go into the details of it, not on today's show, but what I will tell you is that what happened on Friday is what the market was waiting for, and it got exactly what it was waiting for. Jerome Powell, the federal chairman of the Federal Reserve, he comes out and he says some words and some things about the market and what we're seeing in the labor market. I won't bore you to death with the details, but the labor market's been getting a little bit weaker than we would like. Wages have been growing a little slower than we would like, and it's not like we're going into a recession with jobs. We just aren't growing as fast as we once were. And it's not like inflation is going up per se. It's just not coming down as much as we would like for it to. Although the most recent inflation data from the producers index showed a little bit of an increase in inflation. Those producers, those businesses have not yet passed it to the consumer, so that's a good thing. But with all of this in mind, the president has been really hitting Jerome Powell, the Federal Reserve, to lower interest rates. Lower interest rates has been the cry for many, many months from the White House. And we're going to get into it in just a second as to why the Fed would lower interest rates. But what actually took place on Friday was at the Federal Reserve's meeting in Jackson Hole. They met, and the Federal Reserve chair comes out at this symposium and basically says we're going to lower interest rates. And for all intents and purposes, those interest rates will be lowered in September. But what does that mean for you? Well, immediately the stock market went higher. And it was namely companies that have big balance sheets of debt. Companies that have borrowed a significant amount of money all of a sudden are going to see a really nice increase in quarterly revenues that they can spend either on dividends or maybe expansion of their current projects because they don't have to spend as much in debt if interest rates go lower. See, the Federal Reserve does this lowering of interest rates for two main reasons. First of all, the big reason that a federal rate cut would come is to make borrowing cheaper. People who want to go out and borrow money, businesses or individuals for homes or whatever else their projects may be, it could very easily make that borrowing cost cheaper. Most of the time it does. Not always, but most of the time. That borrowing cost being cheaper means you can either A, borrow more, or B, pay it off quicker. For companies, they tend to borrow more or they just pay less towards debt. And most of their debt is kind of structured differently than a normal mortgage that we may be familiar with. So they're paying this debt off in smaller increments, which means they have more money to do other things with. Flexible spending, let's call it. The second reason that the Fed may decide to lower interest rates is because it makes saving money in the bank less appetizing. It's less appealing for an individual to save if they're only making 3.5% instead of 4%. That would represent a 50 basis point cut in the Fed rate. And we expect something around that number in September. So if CDs and savings accounts or money markets become less appealing, then money leaves the sidelines and goes to work in the market, whether it be the real estate market or, in most cases, the stock market. But there are so many things about the stock market that people who save money in the bank aren't super excited about, like the volatility that comes from the stock market. But what does that mean for the average investor who has money in the 401k? Well, the 401k is likely to see a little bit of a bump because of these lowering of interest rates. That's because the stock market went higher. And you could also see a lowering of interest rates affect your bond holding. In this case, it will affect it positively. Net result is your balances will increase. People who are invested in the stock market will likely benefit from this type of investing philosophy from the Fed, saying, hey, we need less money in the banks, more money in the markets. Well, more money in the markets means that the stocks in the market go higher. Now, if you're with me so far, you understand that Fed rate cuts, the interest rate cuts, we'll just call it that for layman's terms, the interest rate cuts are going to make saving money at the bank less interest earning. You won't earn as much interest on your savings. You won't earn as much interest on your CDs. But people who go there for a reason. People who maybe have short-term goals or long-term goals want the safety and security of what the bank offers. So what if you are interested in, let's say, long-term goals and you really want some safety, or maybe you're not even necessarily concerned with the safety. Maybe you're just wanting the money to grow. Maybe you never had money in the CDs in the first place. And if you're a long-term grower of your assets, then you will likely not have money in CDs or savings accounts. Maybe you got it at work in the market. What does this mean for you, and what can you do to make sure that we aren't going to see significant pullbacks in the market if something bad takes place? Well, we're going to give you some advice right after this quick break. For those specifically who are long-term growth investors, stick around because we're going to discuss something that will help you kind of weather the storm of the normal winter. Like I said, September and October tends to be a very volatile month. And I wouldn't let this latest data from the Fed make you think everything next month and the month after is going to be roses. It will still be volatile. It's just historically that way. But how do we take advantage of that volatility? And then after that segment, I promise you, if you are wanting safety and you're wanting some growth in this lower interest rate environment, I'm going to give you some ideas for those who are closer to retirement, perhaps. Maybe you're over the age of 59 and a half and your 401k is not actually the best place to put that money anymore, which is most of us at over 59.5, maybe we should start focusing on the income side. There are ways to put your money to work where it grows in the market upside and it's protected in market downside. Let's talk about it. But before we do, let me reset for just a minute. Let's take a 30-second break. In 30 seconds, we're coming back. We're going to talk about the long-term investor. This is for you who are maybe under the age of 59.5. We're going to give you some ideas to consider. Don't go anywhere. We're coming right back with more after this.
You're listening to the Retirement Matters Show with Dale Smothers. Dale is the founder and president of R.D. Smothers Wealth Management. We specialize in building retirement plans that allow you to walk away from the worry of running out of money. If you'd like to chat with a member of our team, you can do so absolutely free by calling 270-600-PLAN. That's 270-600-PLAN. Visit us online at rdswealth.com and be sure to sign up for our free weekly newsletter.
All right, here we go. So if you are in the 30s, 40s, or maybe even 50s, you're likely what we would consider in the growth phase, and you have long-term growth philosophies at work here. And what I'm talking about are people that are okay with a little bit of volatility, but everybody would like to see their money not have a ton of bouncing around, even if you're young. I will tell you, if you are young and you want to buy stocks, be okay with volatility. It's actually not a bad thing for you. Market falling means you get really good stocks at a discount. But during a normal cyclical, let's say September and October, which is what we see, financial winter kind of settling in, during a normal financial winter with a potential 5, 10, or 15% pullback on the table, what can you do? And especially as we see valuations of technology companies right now at all-time highs, significantly overvalued in some cases, significantly overvalued. What can we do to still give us the upside potential if the market does well, but also preserve some of those assets to where we can deploy them in a market downturn, even if it's just a normal 10% correction, let's say, or like I just mentioned, September down 56% of the time since we've been measuring the S&P 500. How can we take advantage of that, Dale? Well, I would not advise you to move things to cash. That's a lot of times what people will do. They'll sell something like maybe an NVIDIA or a Palantir or Google or Microsoft, something that's been bid up really, really high, and they'll move it to cash. And then they'll try to time it. Whenever one of these stocks fall down, they'll buy it. And I don't know that I would do that, especially right now, because we don't know yet if we are in the early innings of the tech boom or if we are in the late innings. In other words, we don't know if we're in 1999 or if we're in 1996, 1997 of this tech bubble. And for those who lived through the year 2000, you know exactly what I'm talking about. And I'm talking to my younger guys, so maybe I should use the baseball analogy. If we're in inning 3, we're gonna do things different than if we're in inning 8 or inning 9 of this big tech boom. So with valuations like they are and the potential for a small pullback on the horizon, then here's what I would consider. Maybe we take names that we made a lot of money in. We've made a lot of money in these names, NVIDIA, Palantir, Google, maybe even CoreWeave or Microsoft, these companies that have went up substantially. You take these names and maybe you put them into names that are maybe less stretched or maybe they're less overvalued, like Apple and Amazon. And maybe even better, we maybe move money out of those names and move them into an equal weighted S&P 500 index like RSP. Let me help you understand. I don't typically get this detailed in a radio show, but this is good advice for people right now. RSP is an equal weighted S&P 500 index, meaning you still own all 500 companies, but you own each of them equally. Unlike if you buy the S&P 500 index, let's say SPY, if you buy that, you're going to own things like NVIDIA and Google and Microsoft at a much more substantial amount than you would own things like Caterpillar or Walmart or Target or PepsiCo. But if you buy RSP, you own all of them the same amount, which means if the S&P 500 continues to go higher, you go higher. Maybe not at the same rate unless we see a broadening out, which could very easily happen. What does that mean? Well, a broadening out would look like this. You're seeing the NVIDIAs and Microsofts and Teslas and Palantirs and Googles sold at a very high rate, and they move into names like Walmart and Procter & Gamble and Eli Lilly, or names like Walmart, McDonald's, these names, right? And if that happens, that broadening out still benefits you. Now, this is a very good idea for those who are wanting to do some more tactful management. We can help you do that, clearly. But if it were me and you're in growth phase and you're young and you're ready to take on some volatility, be ready to experience that in the next couple of months and be ready to snatch up good stocks at really good prices. Don't be afraid of market volatility if you are young. If you are older, there are things that you must do. And I don't mean you're old, but I'm talking about those who are over the age of 59 and a half and close to retirement income phase. You have got to start focusing on that income phase. And that requires an entirely different type of investing. It's called income-focused investing. We have a portfolio built specifically for that called the risk-on, risk-off portfolio. We have trademarked this portfolio, and we'd love to show you a little bit more about how it works. Don't go anywhere. We're going to take about 5 minutes, and we're going to take a real quick little highlight of how that portfolio works and what we're doing right now inside of it to make sure that your money is working efficiently and not putting that money into the market completely at risk. Don't go anywhere. We're coming back with more Retirement Matters after this.
Thank you for listening to Retirement Matters, presented by R.D. Smothers Wealth Management. If you'd like to speak with us, give us a call at 270-600-PLAN. And if you enjoy the information in this show and would like to hear more, you can access previous shows by searching for the Retirement Matters podcast on the podcast platform of your choice. We also produce a weekly newsletter. Receive it free to your email inbox by signing up online at rdswealth.com.
All right, welcome back to the show. Again, Risk On and Risk Off is our signature trademark. It's the Risk On, Risk Off portfolio. We have trademarked this portfolio. There is an article that you can read that was recently published by the Kiplinger magazine. You can Google Risk On, Risk Off portfolio and read all about it. The premise of this Risk On and Risk Off is that there is a portion of your money that is put in investment types of products that will not move with market downside. If the market goes down, your correlation with the market is zero, meaning your money stays still. If the market goes up, you make money, and you make good money when the market is up. The other side of that portfolio is called the Risk On. That Risk On portfolio is managed by our team. I am actively managing these investments for you behind the scenes, and there are some things right now that we are doing to help mitigate the swings that we've seen in the stock market. A lot of it revolves around options, purchasing options on certain stocks, and I'm going to talk to you about some ETFs that allow you to do very similar things to what we're doing for clients behind the scenes. Okay. Now, this is the Risk On piece. It's not for everybody, and I'm definitely not telling you need to go out and buy these things. I am simply telling you that this type of strategy is what you need to be exploring if you're over the age of 59 and a half and you can't get this in your 401k. So call us, 270-600-PLAN. We can help you start to craft this Risk On, Risk Off approach. First up, I want to talk about the JEPI approach. JEPI is an ETF that is basically a basket of blue chip stocks, blue chip companies that have been around for many, many years and pay very strong dividends. Selling covered calls against those stocks gives you extra income from those companies that already pay you dividend income. So you're getting options income as well as dividend income on a monthly basis. That yield is substantial. Right now, it's over 10% yield annually, and you've got a little bit of volatility in that, but remember, this is the Risk On piece. That is a very strong place to put some money, especially for those who are looking for dividend options. Dividends won't make you rich quick, but they do keep your wealth in a secure place. The second thing I want to discuss is something that we are putting into place for people who are not happy with the rate cut, because, again, it makes saving money in the bank less appealing. You get less interest from your bank CDs now. We are doing this now because the rates are likely to lower pretty substantially at the bank. But there's also an added benefit to this next strategy I'm going to talk to you about, and it's taxes, the way that this money is taxed. This strategy is very simple. We are owning an at-the-money call on the S&P 500. We have a series of puts and calls around the S&P 500 that gives us this return. Every quarter, every 3 months, we have the ability to make as much as 2, maybe 2.5% per quarter. I'll give a 2% low end. And we have the protection of as much as 20% downside in the market. Remember, this is our risk-on money, or this is money that we currently have, let's say, setting in CDs, currently setting in money market accounts. This is an annualized yield of somewhere between 8 to 10% per year in good times of the market, with downside protection against market movement. The market will not take your money from this account. That's the beautiful thing about options. Now, this type of strategy gives you an advantage over CDs, not only for the amount of money you're making, but the amount of money you get to keep, because the taxation on these benefits are much better than that of CDs or money markets. You don't have to pay taxes until you take it out. And when you take it out, it's at capital gains rates as opposed to income tax rates. All right, and just like that, we are at the end of the show. It has went by way too fast, but I'm going to tell you, this time spent with you each and every week goes too fast. I enjoy getting to chat with you. I enjoy getting to talk with you. And here's what I want you to know. There are alternatives. Even in this lowering of interest rates, there are alternatives to investing your money with a sense of security and safety, but still giving you the upside potential that the stock market is known for. The idea is to make as much as we can while risking as little as we have to. We can help you do this. And again, we build it around your income plan. 270-600-PLAN, or navigate to our website, rdswealth.com, and schedule a time to talk to a team member today. And I hear the music ramping up here. We are at the end of time. I've almost borrowed time. Thanks so much to the producers for giving me a little extra. A lot to get out today. I hope that you've picked up on something that's useful. And again, if we can chat in person, that's fantastic. But if the next time we talk is right here on the same station, just remember these 3 things for me. Always save money, plan well, and live happy in retirement. God bless.
Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. R.D. Smothers Wealth Management is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by R.D. Smothers Wealth Management.